Hello, I'm Mark Hebner, President of Index Funds Advisors. Welcome to IFA.TV, where we replace speculation with education. Scott Bosworth joins me again for a second show to talk about the psychology of investor behavior. Scott is a Vice President and Regional Director for Dimensional Fund Advisors. Last week, Scott taught us how our emotions and cognitive biases have an impact on our investment returns. Today, he continues that presentation by talking about how market efficiency and the media play a role in our investment behavior. He explains why it's important to know what we can and cannot control and why it makes a difference. Scott, welcome back to IFA.TV.
Thank you, Mark. Appreciate the introduction. Again, as we talked about in part one, we went through the psychology of investor behavior, the biases that we all have, the need to control for those biases, the need to have a plan with your advisor to help kind of navigate that uncertainty of investing. What I want to pretty much focus on in the second part is on the implications for investors on the research into behavioral finance, because I think it's a very useful field of investment research, of financial research, and it informs the investment process very well. What I like to say is efficient market theory kind of teaches us how to build the car that is going to take us on the journey to financial success. Behavioral finance tells us how to drive that car. It keeps us from getting distracted. It keeps us on track. It keeps us disciplined. And so if that analogy helps you with the rest of this presentation, take that and apply it to your own investing behavior. So there's two people at the University of Chicago, two professors, Eugene Fama, who we work with quite a bit at Dimensional, and Professor Thaler. Now, Professor Thaler and Professor Fama are very good friends and respected colleagues. In fact, I think they used to play tennis together regularly. So these are hardly warring factions of two opposing viewpoints. But they do possess kind of titles that would imply that. The first is from Eugene Fama. He's referred to quite frequently as the father of the efficient market theory. Richard Thaler, on the other hand, is considered the father of behavioral finance, which is oftentimes put as a competing theory, although I think I've showed you a way to kind of dovetail those two nicely into the investment process. But we talked a little bit about bubbles last time, and irrational behavior perhaps causing those bubbles. And I want to give Gene Fama the ability to weigh in on this. He's willing to stipulate that investors don't always behave rationally, but the issue in his mind is to what extent does that behavior affect prices in the market? And it's very difficult to find any evidence that it does, at least in a systematic way that investors can exploit. So there was an article in the Wall Street Journal that actually pitted Gene Fama and Richard Thaler against one another in a very constructive way. And they both talked about the pros and cons of their own belief systems and tried to find some common ground, which I think at the end of that article, the author was able to do. So in that article, towards the end of, I think it was column 1, front page, and this was somewhere concluded in the guts of the Wall Street Journal. I'll read this last sentence for you from Dick Thaler. Despite Thaler's research on market inefficiencies and his research from behavioral finance, he's basically conceded that it's not very easy to beat the market, and most people don't. He admits that most of his own retirement assets are invested in index funds, which is that passive vehicle that was created largely to meet the demands of people that believed that markets were efficient. Now, no matter what side of the fence you sit on, I love to share this quote with people because you might think that because of all these biases we talked about, that the market is terribly irrational, hopelessly irreparable, not efficient whatsoever. And if that's the conclusion you come to, it is contrary to mine, and probably contrary to what IFA stands for. But I'll leave you this quote from Keynes: "The market can stay irrational longer than you can stay solvent." As Dan Wheeler, who was my former boss at Dimensional, used to say at conferences, you might go to your grave as the only one that knew the right price for Cisco. But that doesn't do you a whole lot of good from the implications of your own investment portfolio. So, on to Justin Fox, another prominent author, columnist, and respected researcher into market behavior. He wrote an article several years ago, and I'm quoting him here. It's prudent to assume that the market is pretty close to efficient. On the other hand, we've learned from cognitive psychology, the stuff we talked about in part 1, that ordinary human beings need to have alternatives framed in ways that can help them make the right decisions. Well, that's really good. That's really dovetailing nicely into what we talked about earlier and the implications going forward for portfolio management. But Justin Fox also wrote a book called The Myth of the Rational Market. And on the jacket cover of this book, which, by the way, I recommend, it's entertaining and it's a very good history of kind of market behavior over the past few hundred years. And what I would like to share with you here is this quote from the jacket cover, which is fairly problematic for those of us that believe in market efficiency. It's chronicling the rise and fall of the efficient market theory, that this hypothesis has evolved into a powerful myth that, by the way, it was getting blamed for a lot of problems in the market and with the global financial crisis. This theory holds that the market is always right, and that myth is crumbling. Okay, however, in the guts of this book, which I have already told you is a fairly interesting read, he concludes towards the end that if you have money to invest, the only sensible place to start is with the assumption that the market is smarter than you are. And I think this is a very key takeaway. Again, it gets back to that idea that it doesn't really matter if you think the market is perfectly efficient or if you think that investor behavior does have some effect on prices. What the takeaway for you as investors is that the systematic ways the ways that the market is perhaps getting prices wrong, if that were measurable, isn't systematic and isn't something that we're able to take advantage of as investors. So, I often get asked about the media's role in all of this. And my theory is that the media is in the business primarily of trying to entertain their viewers, sell advertising on their programs or in their periodicals. What they're probably not very good at, they're very good, I should admit, at telling us what's happened, at giving us the current news. But when they try to stretch that into what's going to happen going forward, as if it was prognostication or forecasting, that's where it breaks down. There was an article in the Financial Analyst Journal back a few years ago where these 3 professors basically took a 20-year study of magazine covers from Fortune, Forbes, and Businessweek. What they were looking for was covers that specifically featured an individual stock or a selection of stocks. And what they found was out of that entire library, just under 600 of them did just that over that 20-year period. Now, the one bias in these covers seems to be that there was far more bullish articles on cover stories than there were bearish articles. And what shouldn't surprise anyone familiar with the financial media is that what these were doing essentially, this third bullet point here, is that prior to publication, the stocks that were featured prominently as bullish stocks had done very well relative to their peers, and the ones that were bearish articles had done very poorly relative to their peers. What they found, and they sliced and diced this many ways, and I'm actually taking one of the more flattering conclusions from this article, which was that for 2 years after publication, there was almost no difference between the returns of those stocks that were bullish and those that were bearish. So again, very good at telling us what had happened, but really very poor at telling us any sort of information that could help us from an investment perspective. Now, if you want to name one of the most polarizing or most cited individuals when you talk about financial media prognostications, the name that oftentimes comes up is Kramer's show, Mad Money. I don't bring it up as often people do to talk about his prognostication ability or his stock picking ability. I bring it up only because I read an article in a magazine in Kiplinger's Personal Finance a couple of years ago that actually talked about Kramer from a different perspective. And that was that experts on investor psychology, the very subject we're talking about here, cite him as the guy most likely to push our emotional buttons and to help the viewers make impulsive investment decisions, mainly because of the way that show is created. The colors, the sound effects, the fact that Jim Kramer is the only person on the show, he kind of has that halo effect, as if he's such a smart guy, what he's saying must be true. And it really basically is fueling that whole thing we talked about in part one, the fear and the greed mechanisms that we're trying to avoid letting creep into our investment decision making. Now, if you don't believe the Financial Analyst Journal, you don't believe the psychologist talking about Kramer, I love to share this quote from Steve Forbes in an address to the Anderson School of Business several years ago. "You make more money selling advice than following it. It's one of the things we count on in the magazine business, along with the short memory of our readers." So this is essentially telling us what we think we already know, that the investment media is in the business of trying to entertain the investors, not trying to give them useful advice. If you prefer a more academic viewpoint, I'd like to share with you, this is a very interesting book that I read recently. It might take you a while to get through it. It's not as entertaining, perhaps, as the myth of the rational market. But in one excerpt early in the book, Daniel Kahneman, who's one of the pioneers in investor, or I should say behavioral psychology, which of course leads directly into investor psychology, a major industry appears to be built largely on an illusion of skill. He is referencing a visit that he paid to a major, call it a Wall Street investment house. And in the process of talking to one of the managing directors, his host, this host was telling him how he arrived at the decision to buy or sell a particular security. And after hearing this for the first time, knowing very little about investments, Professor Kahneman asked him a simple question: when you arrive at that decision to buy or sell, who's taking the other side of that trade? The managing director looked at him somewhat puzzled and said, well, another bank or investment house just like me. And that elicited this quote from Daniel, that a great deal of what he sees going on in the investment industry is not really what he would refer to as fraudulent behavior, but what he would refer to as these people really do feel that they are overconfident and they have the skills to be able to give their investors a higher than market return on their investment. So I want to kind of wrap up with some key insights. Now, I've got 4 points that I want to make on this slide. The first 3 are pretty quick to absorb and understand. We're talking about free markets here. We're not talking about private equity or direct ownership of real estate. These are securities priced in free exchanges. In those markets, investors must be compensated for bearing systematic risk. Otherwise, those markets wouldn't operate. They wouldn't function as we see. The other point is that if you have to have a crystal ball, I tell my advisors and my audience, look at the market as your best crystal ball. The market is the best forward-looking device we have for expectations of risk, for prices. Basically, news is so quickly absorbed into prices, and the expectation of the future, the market's expectation of the future, is already there. It's baked into the cooking of the market price. The third point is one where we started to get into this idea that risk is higher. When times are bad, prices go down, risk goes up. We all understand that concept pretty well. The one that many investors forget is that last one, that when that happens, expected returns on those risky assets are going to be higher. Now, I don't want anyone to take away from this presentation the concept that I can time the markets by looking at whether prices are going up or going down. I would argue that the biggest benefit you can have as an investor to work with your advisor to have that approach where we're just going to stick to our plan during good times and bad. And what that's going to mean through the rebalancing mechanism is selling things that are doing well and reinvesting them in things that are doing poorly. And when things are going bad, you're kind of doing the opposite of that. That is the best tool for market timing that I would ever espouse. Going beyond that is simply going to give you a very bumpy ride, and as we understand from psychology, a very difficult path to stay on. So to conclude, you and your advisor in developing that financial plan, that investment roadmap, need to understand that there's things we can control in the process and things we can't. The things we can't control, we've already talked about. Stock picking, picking good managers, avoiding bad managers, trying to time our participation in the markets, the financial media, and the focus of these two presentations, which was those cognitive biases, those emotional behavioral issues that we can't fix them, so we need to be aware of them and manage them. The things we can control, of course, is a familiar list. And it's stuff that you have heard from your advisor and you've heard from people that understand how markets work. We can focus on costs, we can focus on the tax liability and the tax implications of what we invest in and how we invest in them. We can focus on diversification. And the last two, of course, again, the keys to the presentations that I've given you are the discipline and the behavior to stick to your course. So that's all I had to say on the subject of investor psychology. I'm really grateful for the opportunity to speak to all of you, and I'm grateful for the invitation from IFA. Thank you.
Thanks again, Scott, for teaching our viewers about the psychology of investor behavior. There's a big difference between what we can and cannot control, and knowing that difference and responding accordingly can have a significant impact on our investment returns. A disciplined investing approach involves planning ahead and not giving into emotions when making investment decisions. I hope you will seriously consider the important points Scott has made and realize the importance of pre-committing to an investment strategy to avoid the pitfalls of emotional decisions. Thank you for joining us on IFA.TV.